Have you heard the phrase that is often quoted, money is the root of all evil? It's commonly believed that getting into debt is like enslaving oneself. To a certain extent, this holds true because when you drown in debt, your life feels over. While you struggle to pay off your debts, they keep growing day by day. After all, no one lends money for free, there's always an interest to be paid. Despite all this, the United States has embraced debt to an astonishing degree. The total U.S. consumer debt is almost $15 trillion, which translates to an average household debt of over $5,300. Keep in mind that the U.S. GDP is a little over $21 trillion, meaning the entire economy consists of that debt. But here's some good news. Debt isn't always bad. I know this might be an unpopular opinion because most of the debt we have is considered bad debt. You probably have some credit card debts, a car loan, and maybe even student debt, and you're thinking, it will take me decades to pay off all of these debts. How on earth can that be something good? Well, to understand how debt can be positive, let's take a look at how wealthy individuals use it to make even more money. It might sound a bit confusing because why would someone with a lot of money use debt? Isn't it supposed to be for people who don't have money? But that's not how capitalism works. Debt is a powerful tool if you know how to use it. And in this video, you'll find out how rich people leverage debt to increase their wealth. Let's dive into the first point, borrowing. Most of the trade is based on debt. Now, this might sound controversial because borrowing money to start a business is often seen as a horrible idea. Personally, I would never do that. However, in certain cases, especially with traditional businesses, using debt is often the best option. Let's say you want to sell pens, a very common product with consistent demand. Ideally, you would travel to China, find a factory that produces quality pens at the right price, purchase a container of pens, ship them to the US, and distribute them to your clients. Today, this process is mostly done online through websites like Alibaba. However, here's the catch, you don't necessarily have to pay for the products up front. Let me explain. In the past 50 years, China has become the factory of the world, producing nearly everything. Thousands of factories work non-stop to fulfill global needs. To make it easier to sell, most of these factories are willing to loan you their products with the agreement that you will pay them back in the future. Of course, they won't lend to strangers, so you have to build trust with them first. This has been the norm for the past 50 years. Once you sell the product in the US or any other part of the world, you pay the factory and borrow more products. Essentially, you're telling the factory, I know how to sell this. Let me help you sell it. If I can sell it for anything above the cost price, that's my profit. What makes this strategy great is that you're not tying up your own money in this transaction. That's why selling is one of the greatest skills you can ever master. Now, let's move on to the second point, refinancing. When it comes to real estate debts, refinancing is considered the best kind of debt because it's filled with loopholes. If you don't have a mortgage, you're likely paying extra taxes. Rich people always have multiple mortgages to take advantage of deductions. Remember, every dollar you save in taxes is an extra dollar earned. Here's a practical example of how rich people get richer in real estate. Let's say you've saved $200,000, which is a substantial amount of money. But let's be honest, it's not enough to buy a house outright. However, you can get a mortgage of up to $800,000 by making a 20% down payment. So, you find a property that costs $500,000 but is in bad condition and needs renovation. You get a mortgage by making a 20% down payment and spend around $50,000 to renovate the property. Once you've renovated it, the market value of the property rises. Let's say it's now worth $700,000. You can then refinance your mortgage. The bank will provide you with an 80% mortgage based on the new market value, which is $560,000. Out of that money, $400,000 goes to your first bank that provided the initial mortgage, and let's deduct another $50,000 for renovation costs. You're then left with a profit of $110,000. By leveraging debt, you've made a significant profit and still have a property that can generate rental income and build equity. Additionally, having a mortgage allows you to avoid paying taxes. This is a common practice among real estate investors. Can you see now that debt isn't necessarily bad? I'll leave that for you to answer in the comment section below. Moving on to the third point, hedge funds. Hedge funds are designed by the rich for the rich, with the aim of making wealthy individuals even wealthier. These funds often employ unpopular strategies that differ from what regular individuals like you and me do. We try to predict which companies will grow and invest our hard-earned money with hopes of seeing those companies succeed. Hedge funds, on the other hand, employ a completely different strategy. They aim to make money when companies decline or go bankrupt. Take, for example, the case of GameStop, where the internet challenged hedge funds and caused them to lose over $13 billion. But how do hedge funds make money using debt? Let's say you expect a certain stock, like Facebook, to decline. You're aware that Apple, which produces the most popular smartphone, will soon announce that they won't allow apps like Facebook or Instagram to track users' online activities, prioritizing privacy. This news could significantly impact Facebook's business model. So, you call your broker to borrow a single Facebook stock, let's say it costs $100, and you instantly sell it in the market for $100. Congrats, you now have $100 in your pocket. However, you still owe your broker one Facebook stock. Now, if your prediction comes true and Facebook's stock price drops to, let's say, $70, you can use that $100 to buy one Facebook stock at the lower price. You then return that stock to your broker and pocket the difference, in this case, $30. This seems simple in theory but is extremely difficult and risky in practice. What happens if you're wrong or if the stock price doubles overnight? You still have to return that single Facebook stock to your broker and pay interest for borrowing it. In the worst-case scenario, you may have to buy back the stock at a much higher price. Theoretically, your losses can be unlimited. However, with the right team of analysts, this strategy can make hedge funds fortunes. Moving on to the fourth point, Forex. We've discussed this in detail in our previous Forex video, which I'll link in the comments section below. In short, Forex is a market where currencies are traded, facilitating international trade. If you can predict which currencies will rise or fall, you can make a lot of money in this market. But what sets Forex apart from other markets is the leverage it offers. For every dollar you use to trade in Forex, you can borrow an additional $100. This means that if you trade with $1,000, you can hold a position worth $100,000. Even a small profit, like 1%, can be significant when using leverage. However, it's important to note that Forex trading carries its own risks and requires a deep understanding of the market and its factors. Lastly, let's talk about the fifth point, credit score. Your credit score is a powerful tool that every successful business, company, or entrepreneur utilizes in various ways. Borrowing money to finance purchase orders is a common practice among businesses. There are billions, if not trillions, of dollars in banks waiting to be borrowed, and even if there isn't enough money, banks can create money out of thin air. To minimize the risks of lending money, banks require borrowers to have a track record of being reliable borrowers. Building a good credit score helps establish that trust. While high-interest debts like credit card debts are indeed unfavorable, having a lower interest rate can be advantageous. This is why it's crucial to build a track record of being a reliable borrower. By doing so, you increase your chances of getting lower interest rates and minimizing the risks for lenders. If you've enjoyed this video, make sure to give it a thumbs up. And if you're new to the channel, consider subscribing and turning on your notifications. We cover a wide range of topics related to money, investing in the stock market, and more. Thank you for watching, and I'll see you in the next one.